All right, let's get right into it. Today, we're going to master the one metric that really separates the amateur investors from the pros. We're talking about the single number that shows you how hard your money is actually working for you.
You know the feeling, right? It's the question that can keep you up at night. You find a property, you run the numbers, but how do you know for sure? Is this thing going to be a cash-flowing machine, or is it just a money pit waiting to happen? That uncertainty can be totally paralyzing.
Well, what if I told you there's a tool, kind of like a secret weapon, that just cuts through all that noise? It's what the top investors use to get instant clarity and the confidence to know almost immediately if a deal is a real winner.
And that secret weapon is called the cash-on-cash return. Honestly, it is the most powerful metric out there, especially for anyone investing with a loan. So today, we are going to break it all down.
So what is it exactly? Well, put simply, your cash-on-cash return, or COC as you'll hear it called, measures the return you get on the actual out-of-pocket cash you put into a deal. See, it's not about the property's total price tag, it's about your money. It answers that one simple question: for every single dollar I put in, how many cents am I getting back every year?
The formula itself, it looks incredibly simple, because it is. It's just your annual cash flow divided by your total cash invested. So let's break down those two parts, starting with the top number, annual cash flow.
Your annual cash flow is the money that actually physically lands in your bank account each year. This is the total rent you've collected after you subtract all the expenses, and I mean all of them. Taxes, insurance, repairs, property management, and yeah, most importantly, your mortgage payment. It is the pure leftover profit in your pocket.
Now, that bottom number, total cash invested, is pretty much exactly what it sounds like. It's every single dollar of your own money you had to bring to the table to get the keys. That's your down payment, all those pesky closing costs, plus any cash you had to spend on initial repairs just to get the place ready to rent.
Okay, now this is where the cash-on-cash return really shows its power. It is uniquely brilliant because it reveals the hidden advantage of using a loan, what we call leverage, and it's something other metrics just completely ignore.
Just look at this slide. This is the aha moment. Let's imagine two investors, Alex and Ben. They both buy identical $500,000 properties. Now Alex pays all cash. His annual cash flow is a nice 25 grand, which gives him a 5% cash-on-cash return. But now look at Ben. Ben's a bit savvier. He uses a loan, only putting down $100,000 of his own money. Now sure, after his loan payments, his cash flow is lower at 15 grand. But look at the return on the cash he actually invested. It's a whopping 15%.
Just let that sink in for a second. By using the bank's money, Ben's return on his own cash is 3 times better than Alex's. That is the incredible power of leverage, and cash-on-cash is the only metric that truly shows you this.
Okay, so that's the theory. It's cool, right? But now let's make it real. We are going to walk through a real-world example, step by step, so you can see exactly how to do this for yourself.
And don't worry, it's a simple 3-step process. First, we're going to add up all the cash we need to buy the place. Second, we'll figure out our yearly profit. And third, we just do one simple division to get our final return. Easy.
All right, let's plug in some numbers. So for step 1, our total cash invested, that's a $40,000 down payment, 5 grand in closing costs, and $2,000 for some quick repairs. That's $47,000 out of pocket. Got it. Now for step 2, we take our $18,000 in annual rent, we subtract $6,000 for operating expenses and another $7,200 for the mortgage, and that leaves us with a final annual cash flow of $4,800.
And now for the final, easy step. We just divide that $4,800 in cash flow by the $47,000 we invested, and boom! That gives us a cash-on-cash return of 10.21%. And let me tell you, that is a very, very solid return. This looks like a great investment.
But that brings up a good question, right? So 10.21%, what does that actually mean? Is that good? Is it great? Let's put that number into context so you know what you really should be aiming for.
You know, a really good way to think about this is to compare it to other things you could do with your money. A super safe treasury bond might get you, what, 3%? For the extra work and risk of real estate, most savvy investors are targeting a cash-on-cash return of at least 8 to 10%, sometimes even more. So at over 10%, our example property is definitely hitting that target and rewarding the investor really well.
And hey, here's a fantastic little tip to keep in your back pocket. Your cash-on-cash return isn't set in stone. Let's say interest rates drop a few years from now. If you refinance your loan, your monthly mortgage payment goes down. That means your annual cash flow goes up. And just like that, your cash-on-cash return gets an instant boost, all without you having to invest another single pen.
So you see, in the end, cash-on-cash return is so much more than just a formula. It's a mindset. It forces you to focus on what actually moves the needle on the path to financial freedom.
Just always remember this quote. It's not about owning the prettiest properties. It's about owning properties that put cold, hard cash in your pocket month after month. This formula keeps you focused on the cash flow, and believe me, cash flow is king.
So there you have it. You now have the tool, the secret weapon that the pros use to analyze deals with speed and with confidence. The only question left is, what deal are you going to analyze first?